Hey, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to form your own opinions and make your own financial decisions. Today is Wednesday, December 1st, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper XL 007, and it is December 1st, the start of the Advent calendar. And I felt like participating this year in the Advent celebrations. And so this evening, I ended up purchasing a beer Advent calendar, and I will be drinking the Grantler Hell, which is a grumpy German Helles brew. So I'll be participating in this as we go through the episode today. Now, the markets, Viper. Holy smokes, the markets. Last week we had a holiday week. I thought, man, we're going to have a little bit of a calm down, a low volume, and out comes Omicron on Friday, and the markets were not happy. And just to call this to your attention here to see a little bit of what this is looking like, let me just show you a chart here of the S&P. So these are the daily charts of the S&P or daily candles. And you'll see right here this giant red candle. This was the day after Thanksgiving. Well, everybody was, supposed to be Black Friday shopping, enjoying family and friends, and the market decided, hey, I'm done. But look at the size of these candles from Monday, Tuesday, Wednesday, compared to these other things. You want to talk about volatility? Volatility is here right now in the market. And it is putting a lot of names on sale. It's opening up a lot of premium selling opportunity. I myself haven't quite participated in too much yet. I actually ended up putting on a hedge trade, the hedge that we talked about several episodes ago. I actually put that on about 2 weeks ago and waiting for the first leg to kind of pay off. But it has been just a bloodbath in a lot of the different equities in there. So I'm kind of glad that we're not planning on talking much about that this week. I think we're going to go ahead and do the second installment in our crypto series. So take me to a better place here, Viper. Let's talk about some crypto.
Yeah. So, I mean, I haven't, luckily, I guess, been participating too much in the normal market. I have my auto plays that we've mentioned in a previous episode. Those are going along. One of them got stopped out last week, but that's still happening, and we will certainly get around to catching up on what's been going on there. But that's really all I have, which is kind of by design, kind of what that whole exercise was meant to be, was to be a set it, got the profit targets, the stops, walk away, forget it. And I've just been, head down in crypto land here. So on that note, today's installment of the What is Crypto series is part 2, where we're going to talk about NFTs, DAPPs, DAOs, DeFi, oh my, and engagement from the viewing community. A very, very good point that was brought up after the previous episode was a request of, will you be talking about we'll call it the sustainability problem with the current front runners of crypto. And I'm specifically saying front runners of crypto because those are the ones that are really the burden right now on energy and sustainability. It is not a crypto-wide problem per se, as we will see. So I guess in the spirit of market volatility over in the stock land, here is the read on the crypto world. So this is the Fear and Greed Index, which is a very interesting speculative index that is calculated. The website that this comes from, I mean, you can just Google Fear and Greed Index. It explains everywhere that they gather data and insights to come up with this metric. And so basically, if crypto is in a bull run like it currently is, fear is actually a good thing. Fear is your buying opportunity. Fear is when you want to get in. You don't want to buy when we're on the greed side. The range goes from extreme fear to extreme greed. On the extreme greed side, we have a lot of people that are buying all-time highs, pushing all-time highs higher. And fear is when we're kind of in a dip. And as has been covered and people have heard, I'm sure Bitcoin has been doing a bit of a retrace and a pullback of sorts. So far, everything has been within the realm of expectation, though we are approaching a critical level on Bitcoin that needs to hold for the bull market to continue. But for now, fear is good, and this is a good place to be if you're trying to enter. But all of this is actually going to be part 4 when we actually get into the trading and investing in crypto. But I threw this in there because it seemed relevant. So
Yeah,
let's dig in.
one thing here, the fear and greed, I would be real curious. So when we get to that kind of episode number 4, I'd like to try to draw some analogies to the relevant things within the equities world. You know,
Yeah.
I hear fear and I think VIX, but the way you kind of describe that, this almost sounds more like the RSI type indicator, overbought, oversold
Yeah.
thing. So that'd be cool to kind of look at to see how that might compare to some of those other indicators from the equities world.
Yeah, absolutely. And I think in this case, like you said, RSI is probably the better comparison of it, although this is generated from a much more of a sentiment value, a market sentiment, combing social media and just all kinds of different data sources to come up with this. It is interesting to dig into where it comes from. And there are even projects that have overlaid just like you would overlay an RSI on a particular underlying or something, they've overlaid the fear and greed index to Bitcoin or things like that. And there's all, I mean, crypto is just full of interesting data for sure. So today's topic, we're going to start out with the sustainability problem. So for anyone who doesn't know, which if you're getting into crypto or crypto is even on your radar or you know what it means or you've heard the word, it's probably something you've heard of, is that it burns a lot of electricity. And I mean, even saying a lot is hard to quantify. I mean, it's to energy what Jeff Bezos's pocketbook is to finance. It is just super consuming.
I can attest to that. Remember my episode last week when I talked about my very first miner. I'm not kidding when I said it literally heated my basement.
Yes.
Like this is some serious power.
Yeah, absolutely. And it's, I mean, since then graphics cards have gotten exponentially faster, but it's all in a TDP limit, and so we're still burning tons of electricity. And ASICs, same thing. And this is all of a result of this proof of work algorithm, which we talked about on the previous episode. If you haven't seen the previous episode, why are you tuning into episode 2 and go back and watch episode 1, where we dig into proof of work, and they are wildly energy. It is a wildly energy intensive algorithm. However, this is by design, because as we talked about previously, you want to limit the release of these coins and the minting of these blocks. And so you do that by making the work harder. And I mean, as you can imagine, in a world that pretty much literally can't handle more carbon footprints, this is a significant problem. And as the viewer pointed out, in this case, it is a barrier to entry for a lot of people for a very good reason. You don't want to contribute to something that can be this destructive in its current form. So to quantify this a little bit more, we have 2 charts here. We have one Bitcoin transaction on the left and one Ethereum transaction on the right. And both of these are compared to the same 100,000 Visa transactions. So the amount of energy required to do 100,000 Visa transactions versus the amount of energy to do one Bitcoin transaction. In Bitcoin's case, we have somewhere around 1,700 megawatt hours is used to fulfill one Bitcoin transaction, and 148 kilowatt hours to fulfill 100,000 Visa transactions. So to put this into a little more perspective, your average U.S. household, I mean, I live in the world of Florida, so I don't know how much it translates to Ohio, but I would say the average U.S. household, oops, I'm sorry, that was a typo there. It's 1,700 kilowatt hours. The megawatt hours, that's not correct. But the average U.S. household is going to consume on I would say maybe, what are we thinking, 900 to 1,000 kilowatt hours per month? Does that seem reasonable?
Yeah, so 900 to 1,800 kilowatt hours. That's probably pretty average, I would say, for Ohio, for a smaller house. Maybe not in the winter months with not electric heat or something like that. That's probably a fair assumption.
Yeah. So I mean, that's one transaction, an entire month of house electric usage. Over on the Ethereum side, sure, the number looks a little bit better in that one Ethereum transaction is 178 kilowatt hours. However, we need to factor in volume here, and the volume on Bitcoin is approximately, as of the end of 2020, I believe, because I couldn't find more up-to-date numbers fast enough, but towards the end of 2020, we were looking at 400,000 Bitcoin transactions per day. So now you do the math on that, and things start to get really wild. And even more so over on the Ethereum side, where technically the per transaction consumption is less, but we're dealing with on the order of 1.1 million Ethereum transactions per day. So this is, not to put too fine of a point on it, is a problem. Tons of electricity being used up here. So what? Do we just give up then? Which, I mean, not quite. There's obviously different solutions to this problem. They are all have their place of sorts. So obviously right off the bat, we have alternative fuel sourcing. So we could do renewable and sustainable sourcing for energy. If you're mining yourself, you could have a solar array set up. The industry at large will move to whatever's cheapest. And currently, before China cracked down on cryptocurrency, China was the cheapest as far as energy costs, and coal in China was like 4 cents per kilowatt hour, and so everybody just flocked there. So this isn't. I don't really accept this as an acceptable answer because it's just too systemic. There's a lot that needs to change, and we are on that path of that change, but it's going to take a long time. And in the meantime, we're just gobbling up gigawatts, and we need to move to sustainable energy sources, but we can't really rely on that in this current state. So the next thing you can do is research, and the exclamation part is because you should do this always. Research. Don't get into cryptocurrency without researching what is going on. That's part of what this video series is just to be an entry point, an on-ramp to your research. But research and choose a project that runs on or at least supports and aligns with your ideals, because we do that already in various marketing, various decisions we make with our money, the things we buy, the people we invest in. We're already doing that, and you can still do that in cryptocurrency. And if energy consumption is that big sticking point for you, then research different coins, find anything that's based on a proof of work blockchain, Ethereum in this case, and don't support or participate in those projects, and find projects that are built on other algorithms that are way more sustainable. And so that is to the last point, which is choose to promote projects that are not POW, proof of work based algorithms. There's a lot of them out there, and you're going to find proof of stake is the big one. That's POS. PPOS is this concept of pure proof of stake. And POC is proof of coverage. There's all these other algorithms that getting into the nuts and bolts of it is too much for this video, but we absolutely can if it is important to you. But the general idea here is proof of stake. We talked about in the previous video, where people are putting up huge sums of money and using that to become a validator, and therefore the need to limit the crowd is actually done by requiring a huge sum of money be put up. That is to say, the limiting of the participation is not by making the work harder to do. And therefore, in a proof of stake world, the validators, the ones that are still doing the computation that we kind of talked about before, they're just doing it on, a simple laptop, a 90-watt system or something like that, because there is no rush. There is no make this as hard as possible. The whole thing is completely different. And the energy consumption is on the order of 1/10,000th what a proof of work blockchain consumes. So, okay, fine, no proof of work, but does that even exist? This idea here I saw on the news that all cryptocurrency just burns energy like wildfire and it's all bad. And, well, that's because that's what's easy to talk about. There are tons of solutions going on right now that aren't even in the early stages, that are very well matured to address this problem of proof of work. And I'm not even talking about side chains. So obviously on the previous episode, we talked about the Polygon Matic network, which is meant to be more a rapid solution, but it's still a side chain of the Ethereum blockchain, which means if you participate in Polygon and the Matic network, you're still contributing to the Ethereum underlying blockchain. So I'm ignoring all side chains because there are some side chains that are proof of stake, but at the end of the day, they're built on top of a proof of work blockchain. So forget all that. So what we have here are projects that I find very interesting. There's many more than just this, but these are a few that I am very interested in myself. And that is the Chia, which we won't even call that as green as they advertise it. We'll call that gray. I'll explain
but the
that in a
logo's
second.
Green, Viper. How does it mean?
I know. And if you look up Chia, you're going to see they advertise a green currency for the digital age. Now, I don't want to be ripping on them too much. It is great. It is fantastic, but it is not as good as proof of stake. But I'll get to that in a second. So the other one is the Helium network. So this is a completely very specific intent on building out the blockchain. This one is based on a concept that they coined as proof of coverage, where you run a hotspot device, and it is currently basically being out a decentralized wireless network. And this thing consumes the electricity of a Raspberry Pi. Its intent, the blockchain's intent is, like I said, to build out this decentralized wireless network. However, all blockchains can service transactions all the same, and therefore it could be used for all sorts of other applications, distributive applications, which we'll talk about in a minute. So just because it's doing this, building out a decentralized wireless network, doesn't mean it can't handle validating transactions and things like that. And now it's validating them on little 10-watt or less devices. But even better than those is the one on the bottom there, Algorand. So Algorand is based on this pure proof of stake concept, PPOS. Basically, it's already very minimal in its carbon footprint, and they are trying to take it one step further and, get some marketing dollars out of it to advertise themselves as carbon negative instead of just carbon neutral. And they're doing that by investing to offset what their current footprint is to different climate funds or whatever. And Avalanche is another network that is also proof of stake, and Avalanche is incredibly interesting. Would love to get into that at some point in the future. But Avalanche is also very sustainable. And not only that, but Avalanche is really doing some incredibly unique things that remind me of what Ethereum was to Bitcoin 4 years ago. That's not an energy statement, but that's just a incremental improvement to the crypto world statement that Avalanche has the power and potential to power a ton of applications, a ton of services, and it's going to be doing that in a sustainable way. So these are all things, get your Google fingers going and just go nuts on these sorts of things. So backing up real quick to kind of what I was saying about Chia, the thing of Chia is it's hard drive mining, and so to really fast sum it up, you're basically, instead of doing the work to create or to find that proof that we talked about in a proof of work scenario, you basically pre-create a bunch of bingo cards and store them on your hard drive, and then when a challenge gets issued to the network, you check your Rolodex of bingo cards and you say, hey, I got it. And you have 30 seconds to respond to say you have the solution. And then you submit that. And that is how it is solved. So that is all very energy efficient. I mean, hard drives, run 1 or 2 watts for, 18 terabytes, which will hold about 150 of these bingo cards on it. However, creating them is still work intensive. So to create the cards, which is the plotting process, as to continue to use the lingo of the chain, that is still very energy intensive. But it's a quick burn to create them, and then the goal is that people just store them. However, that's not always how the world works, obviously. So people will constantly be creating these plots, and so while it is much less energy consumption of everybody constantly running the proof of work algorithm, it's not as green as Algorand or something that's proof of stake. However, the Chia network, I think, is very interesting. Just maybe not the home run on energy efficiency. So going to Algorand, this is a statement that's on their website, and this just kind of is what I mentioned before, that Algorand was built as a green blockchain with an environmental impact focus from the very beginning. Their founder, made it his focus back in 2018 when they created the blockchain, and it uses a unique consensus mechanism, which I said is pure proof of stake, PPOS. That's a very fun comparison to Google around POS versus PPOS, because there are a lot of in a very young blockchain, which Algorand isn't even a young blockchain. It's very matured now, but in a young blockchain, there are a lot of risks to a 51% attack on a proof of stake, because it would take not a lot of money to get 51% of the network. However, pure proof of stake goes one step further to really try to mitigate that. So it is a very unique consensus mechanism, and they are, like I said, trying to offset their carbon footprint by partnering with the Climate Trade Organization, just to really squish that last little bit, and then they get the marketing gains of saying we're carbon negative because we're actually offsetting all of that. And one last fun tidbit on Algorand: the Marshall Islands out there in the middle of the Pacific have actually adopted Algorand as the national currency. So if you think this is some meme token just boot, like, no, this is a real blockchain that is doing all sorts of things to be a major player in this new future space of being more sustainable. And like I said, when you're looking at getting into a usage of crypto, whether it's certain applications or whatever, you can always find out what blockchain it runs on. And as we go forward, things like Avalanche and Algorand are going to be popping up more and more, and then you just use those services, and then now you don't have to worry about the sustainability problem. So this is a growing space, and I don't think it's going to get any smaller, and there's just more and more focus and emphasis on that sustainability. So there is a lot of sustainability options out there already out of the gate.
Yeah, I kind of going back to when you're talking about, boy, do I just like throw in the towel and quit. One of the things, the parallels I draw in my mind are no, quitting is usually never the right answer. I think back to when I was much younger, right? As a kid, we would always get, the local farm butcher meat or things like that. And then there was a long period of time where that just became not the cool thing to do. And a lot of supermarkets and mass produced food and venues and stuff like that just were everywhere. And it was really hard to find like the farmer's market or the local farm raised things. And you kind of look in the past maybe 10 or 15 years, that's really come back into popularity. I don't think you can go to any major city and not find a plethora of various farmers markets or different ways that the sustainable food or organic food is there. I mean, 20, 25 years ago, try to find organic food. And that didn't come about because people kept their pocketbooks in their back pocket saying, wow, if it's not what I want, I'm just not going to buy it. They sought out those things that they were looking for, and they paid a premium for them.
Yeah.
And that's really what drives the cost down. At my house, for example, we don't have solar. Like solar is not that big in Ohio. It's pretty cloudy here, but my electric company offers me the ability to pay for electricity that was generated through sustainable forces and transmitted somewhere. So most of that's wind, but it's some of it's solar, and I pay more per kilowatt hour than I would have if I didn't go for that. But that's because I want the electricity that's in my house to be derived from sustainable sources. And I think the same can be true here, right? The crypto,
Yeah.
it's not going to stop crypto. Crypto is probably coming and likely in my lifetime might become the predominant transactions of the world. And so just kind of sitting on the sidelines doesn't really help get to that sustainable mark. It's doing that research, seeking it out, finding out what things fit uh, your thought process, and put your money there, invest there, spend, participate there.
Yeah.
That's where the sustainability comes across my plate. Is I would never think of turn tail and running because yeah, it's just going to consume a lot of energy. It's okay. How do we start pushing this in a different direction?
Yeah. Yeah. Absolutely. And that's a perfect analogy to food sourcing, sustainability in our food production. It's the same thing here, and I mean, I think from my journey down this rabbit hole, it will well be within our lifetimes that crypto is. We missed. If you wanted crypto to just go away and disappear, you missed that boat. It didn't happen, and it only just keeps snowballing and getting bigger and bigger. And there is a lot of noise in the system right now, and we'll talk about that in future episodes when we get into exchanges and trading. But the foundations here are the kinds of foundations that future economies are not just built off of in the future, but they are being built off of right now. Like I said, the Marshall Islands, I think it's somewhere in South America that is escaping me right now, that adopted Bitcoin as the official currency. Just things like that it's already happening. However, that doesn't mean you just have to accept whatever everybody else is doing. Your options are still just as wide open as they always are in anything else. And you can find that sustainability is a very important thing to the crypto community, and just keep, like everything else, just keep chasing out and participating in those things that align with those ideals that are important to you. And my main point in all of this is, if sustainability is preventing you from getting involved, there's too many matured options to let that continue to prevent you. Going back to research, don't just blindly jump in. But you'll find out very quickly there are some amazing projects with huge potential in the future that can also align with a sustainability view of the world, which is awesome. So, what do you do with a blockchain? And that's where we're going to go now with applications. So DAPPs, decentralized apps. This is where I'm going to kind of try to breeze through these concepts, and then we will drill down as requested or as desired, because there is just too much content in the crypto sphere, and we're just trying to keep you on the surface and skimming along the lake here, while also giving you something to chew on and type into the Google text box. However, so decentralized applications, this is the same concept as any application, as the application you are watching this video on through YouTube. It's just done on an entirely new platform. So what we mean by that is, in the current world of applications, just picture your favorite app on your phone. You have an app you have a code program that's running on your phone, and you're giving it data. You're doing whatever it's meant to do, and you're sending that data off into a cloud server somewhere, a back end, and it's going through the internet to this back end, and it is a centralized back end that's owned by a corporation. Almost always it's going to be, in most of the commercial world outside of open source and whatnot, it's probably a very closed, tightly knit, tightly sealed back end. Now, in decentralized apps, you're going to have the same exact thing. You have an application on your phone, on your computer, whatever. It's going through the internet, but now it's communicating to the network that it is running on, Ethereum or Algorand or whatever. And it's communicating to that to all the nodes of that network to either go fetch whatever information it needs, to go log or store whatever information you're trying to send to the network. And that, at a very high level, is the main difference, is it's now communicating with this. Just replace the cloud with, it's still sort of a cloud, but it's now just a decentralized cloud that is owned by no one and supported by everyone. Not currently, but always, these apps can only be run on networks that support smart contracts. So you will never see a DApp on the Bitcoin blockchain. The Bitcoin blockchain was meant to serve one purpose, as we talked about before, and that is the store of value. It is the physical gold equivalent in the digital world. That's its entire purpose. It will never do applications on it or smart contracts. It potentially could, but it's just the controlling community of Bitcoin have no interest in converting Bitcoin to proof of stake. It is just going the way it is, and there's nothing on the roadmap to indicate that it will ever convert to a smart contract system. So right now, Ethereum is going to be your biggest smart contract system. However, Cardano was in the news big over the past year, and it exploded. It's a proof of stake network, and it adopted smart contracts. It integrated smart contracts. So now people are building apps on top of smart contracts, or apps on top of the Cardano network. And the thing about smart contracts is they are very powerful, especially in use cases of finance. Basically, a smart contract is this programmed agreement that's written in code between two parties, that will execute when a certain trigger is hit. And there is no stopping it. You have agreed upon it, you've put it in code, and you've sent it to the network, and now it's going to sit there, wait for the trigger that you agreed upon, and it will execute. So that obviously the finance world, that agreement could be, I'm going to pay Sprocket X amount of money when he sends me this NFT address or whatever the asset is that he's going to send me. It's now that contract is going to sit there and it's going to wait, and it will see him transmit that asset to me, and then that smart contract we already agreed upon automatically triggers. My money goes to him, and now we're living in a decentralized finance world where there was no third party involved, and yet this was probably one of the most secure transactions between two parties you could have, because this is executing code is all it's doing, and we already agreed upon the terms of it, and now nobody can cheat out of it or whatever. So at a high level, that is what the power of the smart contract is. And then you basically, in an application, you just use that contract for anything your mind can dream of as a developer, for any app on your phone, whether it's a game, whether it's a financial service, whether it's a security thing. You use these smart contracts to program in these events, and then you carry them out. So, for example, the top 10 decentralized apps today, the very top one is a game called Upland. And this is actually a game that's on iOS and Android right now. You can go download it in the store. And this kind of gives you an idea of what we're talking about here, because there is no, like, the mass adoption of cryptocurrency happens when everybody's using it and they don't know it. You could have stumbled across this Upland game in your mobile app store. You could have downloaded it. You could have been playing it, and then you didn't realize it until you watched this video that it was based on a blockchain. And to me, that is when we're really getting into mainstream penetration of cryptocurrency, because no knowledge of blockchain is required to get into that. And then you can go down the list and you can see, well, it might be hard to see, but right next to the game name is the platform as to what blockchain these games are running on. So you can see the second one there is OpenSea. This is an NFT trading platform that's based on the Ethereum. Right below that, though, is this Solar Beam, which is an exchange. It's a financial services that it runs on the Moon River blockchain. So you can see, as you go through that list, and that's part of that research as to how you can find what runs on what. It's not a secret. Everything is out in the open, and maybe you want to play a game, but if a game runs on the Ethereum blockchain, then there's plenty of other games out there. So that's the gist of decentralized apps, and at a very high level. And obviously, like I said, we can go more into detail as required, as requested.
So leave a comment below if you want to know more.
Yeah. Or if you're a bot shilling some other YouTube channel.
Yeah. Post bots. Go ahead and post your favorite apps that you like to shill too.
And then so some of the other terms that are going to come up as we go down this rabbit hole, but these are probably entire, episodes on their own. So DAOs, DAOs, these are decentralized autonomous organizations. So the elevator pitch on what I could best summarize a DAO as, it's an autonomous organization that lives on the blockchain and it ensures smart contract execution. And like we said, there's no third party involvement needed. And this is as the name implies, an autonomous organization that is going to carry out the rules and the execution of what the blockchain was built for, and keep it organized, or keep it functional in some ways. NFTs, I mean, that was supposed to be a big part of this episode, but it's just it's such a big thing that it could be a whole episode if we needed. But basically, NFT stands for non-fungible token, and that it means that this is a token that cannot be replicated. It cannot be duplicated in any way. It's an authentic token providing verifiable ownership and rarity of an asset. Now, the current implementation of NFTs is done so in some not great ways, and that is particularly in the world of art. You have all of these art NFTs. The concept is spot on, in my opinion. However, the implementation still leaves much to be desired. And so what I mean by that is everyone's seen it by now, I'm sure. Somebody buys some GIF, on the internet for $60 million. And that's not even an exaggeration. That's, this is the kind of money that people are spending. It's the collision of the art community and digital world. Now, why I say that I think the concept is spot on, because the artist that came up with that GIF or whatever, they can build a royalty into the NFT. So let's forget art for a second. Well, forget drawn art or whatever. Let's go to music. This potentially means that there is a very sustainable path for musicians to sell NFTs of their music. And so potentially a song doesn't play, a sort of a form of DRM perhaps, but to verify your ownership. But most importantly for the artist, that anytime you sell, this is an album. This is album from band X, and I'm done listening to it. I'm going to sell it. And so I sell this album. The artist can build in a royalty that every time this is sold, I get 2% of the cut. Obviously in music, that's a pretty flat market as far as value increase. So now going back over to drawn art, created art, as an art, there's always the running joke that if an artist wants to be rich, they just have to die. That no longer has to be the case, because they can build this royalty in such that they sell at a floor price, they sell their art, and then as collectors go around and go buck wild with it, the artist can still get a slice of every single one of those sales. Now, the reason that I say today's implementation is a little rough around the edges is because really when you buy an NFT today, you're buying this verifiable certificate, but that certificate is still pointing to somebody else's internet server, somebody else's database that says, I own this image, but also Jim Bob over there is the one that's hosting the image. So maybe Jim Bob closes his server down, and now you just have a contract and it points to a 404 page not found. That's not the case universally, but that is definitely a big problem right now. Is there is still a missing link of, holding the file, having the file coupled with it. That seems to be a pretty trivial problem to solve going forward. And obviously the music case, there's just a ton of use cases for NFTs at a more fundamental level. Sports tickets, you could, the sports team, the venue, whatever, they can build that royalty into the sales. And you could sell your tickets, without going through Ticketmaster. You could just directly sell a ticket to a friend or something like that. Just all sorts of implementation options and possibilities with NFTs that they are not going anywhere anytime soon. However, what you hear about and what you see in the news is like a new stock trying to find its price level. There's a lot of bad implementations that could be improved. There was a recent, I forget what it's called, but somebody went through and they called it like the right click project or something like that. And they just went around and they heisted every single NFT that's ever sold by right click and saving it. And it's literally downloadable in like a 2.5 terabyte file. And you can download every single NFT that's ever been sold. And that's just not meant to be malicious. It's just showing the weakness of our current implementation of this system. And lastly, we get to DeFi, which is decentralized finance. And decentralized finance is basically all the same services of CeFi, centralized finance, but the services are being provided by the user network of the blockchain in a much more secure and decentralized way. So to step through that real quick, what we're talking about is these are familiar financial concepts. They're just done in a new digital age implementation. So financial services that are served and funded by the network participants. So things like staking and liquidity pools come a lot. These are two fundamental pieces of an exchange. So when I say exchange, picture your stock brokerage or something like that. This is an exchange that's meant to swap tokens, sell this one for this currency or whatever. And the way that DeFi comes into this is, say I have a bag of, Algorand, and I say, hey, I'm okay with locking up 90% of what I'm holding. I maybe I need 10% of my account to make purchases or do whatever I'm doing with the token or the coin, but 90% of it, I don't need it readily available. So I could enter into a liquidity pool with that, and I would get paid. So basically I'm giving my coins up, not giving them up, but I'm letting them be borrowed and contributing them to this pool that people can take loans out of, and use. And every time somebody does that, there's a fee associated with it. And then that fee goes back to me. And this comes in as some sort of APY, or interest percent that I'm earning back. There is a thing called impermanent loss, and to make that super simple, all that means is this pool says we will pay you 10% APY on whatever you contribute to the pool. However, if this is a very volatile token or coin, impermanent loss is, okay, I contributed that, I'm getting paid 10%, but the coin shot up 50%. I don't have access to that 50%. I'm getting paid the 10%. And that's what an impermanent loss is when it shoots up or shoots down. And you either get stuck with the bag on a very much less valuable coin, or you didn't get to participate in, the price run up. Now, the loans that happen here are 100% collateralized. So it's not at all as risky as that initially probably sounded, of I'm giving these coins up and letting them be used in this borrowing or whatever. What we mean by that they're 100% collateralized is, in order for somebody to borrow those coins, they have to put up, as part of their smart contract, they have to put up an equivalent collateralization on that loan. And then if that loan ever falls into what we might traditionally consider a default characteristic, then that collateral becomes mine. And so I'm not risking anything other than that impermanent loss of price volume or price fluctuation of that coin by giving these coins up. And in return, I'm getting that APY, which varies wildly by coin and by liquidity pool, because the liquidity pools are going to give more reward for coins that they need more of, and they will give less reward for coins they need less of. Simple supply and demand. So what this does at the end of the day is it makes financial products open to anyone to use without going through a middleman provider, such as a bank, a brokerage, etc. You could get loans. You could, get interest, high interest at today. I mean, it's probably not going to last forever, but the standard interest on a lot of liquidity pools that are out there is 20 to 30% interest rates on certain coins on average. Staking or providing liquidity for Ethereum or Bitcoin, you're going to get 0.1%. Okay, you're above a savings you're above a savings account at your bank, but that's about it, because liquidity is just not in short supply in either of those coins. However, that 100% collateralization is a key component to making that available, and there's a lot more about that would be great to get into. That is the episode 2 of What is Crypto?
Nice. So I got two kind of questions. I guess maybe a question and a comment. Question first. I think I recall that you were telling me you did buy an NFT.
Yes, I have 2 of them.
And what do you do with this? Like, how did you receive it? What did you do?
Yeah, so there's one of the main implementations of NFTs right now. So the 2 projects I participated in are 2 very different projects. The first one is more the norm, where you have a project that's getting up and started, and they create this artwork. They create components of the artwork. So, I mean, everybody's probably seen an NFT of whether it's Jiffy cat, or, a cat with, just different attributes, glasses or blue background, red background, whatever. The artist of these projects, they come up with a bunch of art assets. So they'll come up with different glasses, they'll come up with different smiles, they'll come up with different shirts and ties and things like that. And then they'll open up a minting procedure where it's a floor price. Everybody buys it at the same exact price, whatever that is, 0.06 ETH or whatever. Everybody mints at the same exact price. However, when you mint, you have no idea what you're getting, because the art has not been put together yet. All those pieces and components are drawn up. And so it's a lot like, a deck of cards or trading cards or something like that, where you haven't opened it yet. So you've paid, you've minted, and then usually about a day or two after minting opened, they'll close minting, and that's when the actual artwork is randomly generated. So there's a computer algorithm that'll go in and it'll say, okay, I want one of these glasses, one of these mouths, one of the da da da, and then when it's all done, the collection will be, say, 1,000 large, because that's how many people minted an NFT. And then the computer knows, hey, out of 1,000, I only used glasses on one of these. And so now that's giving it a rarity ranking, because it's the only one in 1,000 that has glasses on it. And that's the gist of at least the creation. So now there's usually projects built behind that. And I say usually because, again, we are dealing with the wild, wild west. We are dealing with opportunistic, people just trying to scam people in the system. However, one use case then is, so there's this, one of my NFTs is this thing called Doge Fighting Club. Be honest that I did do research. I did find, before I got into anything, I found a number of metrics that you can go through and you can gauge the seriousness or the rug pull potential for something to be a scam. So I didn't completely go blind, but I also went into this not expecting anything, and just trying to feel out the whole thing at large. However, this Doge Fight Club project, now I have an NFT. I have a Doge Fight Club dog that has all these different characteristics. I should have pulled up a picture or something. And they are building a game in which this will become my fighter character in the game. I can then level him up in the game, and then I could sell him to other players if I wanted. I leveled him up, and I'm like, hey, I got him to level 10. That's 2 Ethereum for you. That would be an amazing day if I can sell that thing for 2 Ethereum. But that's the general gist behind it. And to be honest, there's so many projects that come cranking out. Guaranteed most of those games never fully come to fruition. Maybe not as a scam, maybe just they bit off more than they can chew. However, there is still the collectibles market that is always ongoing. And so for this one, I'm not particularly interested in sticking around for the game because this is an offshoot project. So I'm mostly watching the market price of the whole collection. I know my rarity against the collection, it's not great. I'm somewhere right in the middle. So really on this one, I'm just kind of looking to, as soon as I could turn a profit, I'll sell it, or maybe I'll forget about it and come back later. The other one was, again, same process of generation, but this one is based on, it was a project that's actually sanctioned and backed by Sony Pictures. And it was a build-up for the new Ghostbusters Afterlife movie, and they did this collection of mini puffs, the Marshmallow Man, and they minted a collection of these little, honestly adorable mini puffs, Marshmallow Men, and it's a character in the movie. The director of the movie was involved in the project. So from the get-go, this is a much more official project, if you will. Now, the benefit to these NFTs are the director as well as the writers of Ghostbusters, and this is the director of the original Ghostbusters that did Ghostbusters Afterlife. This NFT is actually going to act as a ticket, as a pass. So the director is going to do a series of video seminars in the spring of how to tell good stories and, just storytelling in general. And there's a series of 7 or 8 videos, that they're doing. And so these NFTs act as your entry pass to these videos. And so that is another way that a project might, so they're not making a game out of it, but they're adding value to it, because now anybody that is in movie making might want one of these NFTs. And I haven't decided. I'm going to wait and see, as we get closer to the first of those events, we'll see what that does in the market.
So
and not
what do you have? What did they give you for that? Is it a file? Is it like what did you take delivery of?
so it's, I mean, yeah, it's, I honestly, that's that's the problem, is that I
You don't
don't
know?
have, no, no. The problem is I was not given a file per se. I was given an asset in my cryptocurrency wallet. I have in my wallet, I have a contract, a coupon, if you will, that says I own this thing, and there's a pointer to it that goes to the image, so that way I can see it and whatnot. But I did not take delivery of said image. That is
Okay, okay.
one great weakness of the current system, is whatever server that's on could disappear tomorrow, and now I have nothing but this piece
So
of paper.
let me just try to, I'm still trying to wrap my brain around this here, but the way that I'm hearing this described is what you've essentially have, and I could be dumbing this down too much, is a public ledger, because that's what I understand from Bitcoin, yada yada yada. A public ledger that says entity X owns asset Y, and asset Y is denoted by, let's say, a hash of the file or something like that. And so should that resource or that asset, that digital whatever it is, go away from that server and show up on my computer, and I copy it and I post it up on the internet, and then thousands of people have it, and then everyone's like, boy, I wonder whose this actually is. They would look at that file to take the hash of it or the fingerprint, and they would have to reference the ledger to say who owns this. And that's really where the ownership is tied. Is that correct?
Yeah, that's correct. Because
There's just a ledger, and the ledger was locked in with cryptography that says this asset belongs to this person. But
yeah,
that's the part I don't get with NFTs, is they are like, oh, well, that's just this one unique thing. And you can't ever have that one unique thing, right? I could copy it. I could make 1,000 of it. But what you can't change is you can't change that ledger. And I
right.
think that's what gives it the tie back to a person.
It's too overgeneralized, but just say a block on the chain has data in it that says I own that block, and in that block is the pointer to this picture or this file or whatever, and that's what I own, is that block. If I sell it to you, now that's your block, and that's how the picture can get distributed all over the place. And that's also kind of the joke of that right click project. But for anyone to claim value, you have to own that actual piece of the blockchain, and that can't be duplicated.
Yeah, my comment is the DeFi, that is of particular interest to me. That strikes. I can see practicality to that. I can see usefulness to that. And I think back, and maybe we'll end up doing an episode on this or not. I'm not sure, but I think back to one of the very, very early investment things that I did. I'm talking 15 years plus now. There was a service out in the world, and I think they've reincarnated themselves in some form or another, called Prosper. And what it was basically an exchange where you could go as somebody with money, and you could lend money to some rando stranger in the world who couldn't
Mm-hmm.
otherwise get a loan from a bank, credit restrictions or things like that. And I did not fund that entirety loan to them. I would basically go into a pool with a bunch of other people, and we would say, well, this guy's risk category is this, and so we're going to offer him a percentage interest rate of this. And you could choose if you were willing to chip in to that loan, right? So the users didn't actually negotiate the rate of the loan. The person asking for the loan asked for a particular rate, and they gave all whatever their circumstances are, and then different lenders would come in, and the lenders, not being banks, they would be people like me and other rando people that wanted to invest, and they would say, oh, I like this person, you know what, I'll give you $50. And so out of the $5,000 loan that they were trying to get, I lent them $50, and they would get hundreds of people to do that. And then they would get their loan, they would pay the loan back to the service, and the service would distribute that portions to the different lenders that participated in it. I know it's not the same, but it's that similar empowerment of bringing financial transactions to people that were otherwise prohibitive from getting them. And so
Yeah,
that
yeah,
that's
no,
really interesting to me.
yeah, I think that's, I mean, for all intents and purposes, that's a perfect example of the spirit of DeFi before there was DeFi. Because now the purpose of DeFi is to service that exact scenario, but to do it in a much safer, more reliable way. Because in that scenario, you were still dependent upon the solvency of the proper organization who was acting as the middle, the middleman in this whole thing. Um,
Spoiler
so
alert, they went bankrupt. They were not they became insolvent.
case in point. So, um, so yeah, and the way some of these liquidity pools work is, and again, this, I do not expect this to be the case forever, but like currently, it's shaping up to be one of the safest. And I mean, this is not financial advice, and this is absolutely something you need to research. But one of the, we won't call it the safest, but one of the safer plays you can make in crypto right now is participating in one of these liquidity pools, and specifically on something called a stable coin. So a stable coin's whole purpose is to match another currency. So there's stable coins for the US dollar. And I guess this is a spoiler alert for future conversations when we get into exchanges and actually trading and investing in crypto. But a stable coin's whole purpose in life is to match the US dollar. And so by whatever means necessary, they alter and keep one of these stable coins to be as close to $1 as possible. And the purpose here is there is no high volatility in the price change because it's staying flat. Now, in one of the cases of liquidity pools I've participated in, the exchange starts to, the pool starts to give out loans, and the available liquidity of the stable coin gets less and less and less. And when that gets pinched, I've gotten up to 123% APY just for putting in, however many of these stable coins I put in, because I'm providing that much needed liquidity as, supply and demand is the supply is shrinking. And now this is a variable interest rate. So I'm not just, racking in 123% all day long, as great as that would be. But that shows, as far as investments go, that is a very low risk situation, because whatever I put in the pool, like we said, is 100% collateralized. So there's no risk of me not getting it back out, because whatever happens, there is collateral put up to whatever somebody borrowed out of that pool.
Yeah. The other analogy that was jumping out to me when we were kind of talking about that, and you're talking about the safeness of it and the risk relatively low, yada, yada, yada. I look at option selling, right? A lot of the derivatives market is very similar to that stuff. And so I actually think those yields likely could stay something like that. And in the options world, you have similar high yields based on the volatility and things like that. And option sellers make more money when the premium goes high, when the liquidity, I won't say liquidity, when option sellers provide liquidity to the market. And when the liquidity is dried up, there's a higher premium for those option contracts to come in and make those sales. And when you do them, you can do them in a way that is much more safe than I think certain articles might lead you to believe. And so they are a relatively, or can be a relatively safe investment. And so I just see a lot of parallels to that DeFi into different ways that I over time have invested or tried to trade some of my capital.
Yeah, which makes sense, because it's meant to be the financial world just as you know it, but decentralized.
Well, that brings us to the end of this week's episode. It brings us to the end of the conclusion of episode number 2 in our crypto series, Introduction to Crypto. Like we mentioned multiple times, there is so much content to dive into here. We just can't spend that much time in one episode on there. And so we're going to rely on you guys, the viewer, to give us the feedback on what areas do you want to hear more about. We got a little bit of viewer feedback before, and we really dove into that sustainability. So leave a comment down below. Hop in our Discord. There's a link in that in our description. Tell us what you're trading. Tell us what puzzles you about crypto. I guess I get a little bit spoiled because I can kind of just ask my questions as I come up with them. But I know that you watching this are thinking about them. We want to hear what kind of questions you have. Let us do the work and dig into them, and we'll bring that result to you in future episodes. Aside from that, it's getting pretty choppy out there. Volatility is really high in the market. For option sellers, this is prime selling time. Volatility is high, which means premiums are high. You get a reversion to the mean. So get out there, do your scanning, find some good plays, and remember, think outside the block.